We're talking all things capital gains. In this episode, we're going to address how do you reduce your capital gains, especially if you have an investment property. An investment property is going to be difficult because if you've owned it for a while and you've gained a lot of gain in it, one, that's great and terrible all at the same time. And then on the other hand, you have probably depreciated it to almost zero. And so as far as the IRS is concerned, it should be worthless, but you're probably selling it for close to $1 million. So you're going to have a significant capital gains tax. And of course, tune into our other episodes if you have any questions about this, because there are gains taxes for federal, state, city, county, depending on where you're located or where the property is located. So how do you solve this problem? The short and long answer is a 1031 exchange. 1031 exchange references the section of the IRS tax code that applies to this. And in essence, what you're doing is you're selling your property and buying another property. It has all kinds of rules associated, but at the most basic level, that's what it is. So I sell my property. I have 45 days to tell the IRS what other properties I'm intending to purchase. And then I have about 6 months to purchase one of those properties. Now, the other big thing is that you have to buy something that's at least $1 more expensive than what you sold, or else you're going to get this weird thing called a boot. So I always think about Italy. I don't know why, I just do, because it's called the boot, of course. But a boot is when you decide to take some of the proceeds from the sale and just keep it for yourself. You're going to have taxes applied to that part of the sale, but not the entire sale. So you can do what's called a partial exchange. Now, there is so many complicated rules about this, but the really important stuff that you need to know is what is a like property. I can sell whatever the investment property is, and I can exchange into pretty much any real estate. So that could be a farm, a commercial property, a multifamily property, a 10-plex, a vacation home. All of those things are on the table. A lot of people have a concern that like, oh, I have to, if I'm selling a single family house, I have to buy a single family house. That's not at all the case. So you have a lot of options available to you. Really, the biggest constraint is the time window. They don't give you very long to designate after you're closed. And you don't have very long you have plenty of time to close on the property, but you really have a very short window to determine what you're going to replace it with. As always, you're going to need professionals to make this happen. I really highly recommend a real estate professional, your CPA definitely, and you're going to also need a third-party exchange company, because if you touch that money, everything is gone. You cannot get your hands on any of the money. So the money actually has to pass through a third party called an exchange company. They take all the proceeds and they forward the proceeds to the title company or whomever you're going to be purchasing the property through. It's complicated, but I've done it plenty of times, and it's a fantastic way to avoid capital gains. And just to be super technical here, you're not actually avoiding it, you're really just postponing it. So, down the line, eventually, you've got other ways to continue to avoid that capital gains, but 1031 exchange just postpones them. As always, it's a pleasure talking taxes with you, and we'll see you next week on our Home Happy Hour.